From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. You're listening to the HPS Macrocast. It's Friday, March 27th, and we made it to another Friday. In a week where the medical numbers, the health numbers, are getting worse, but we got maybe some good news on the economic front, in the sense that we have this gargantuan fiscal package that's finally looks like it's going to make its way through today, and we'll see whether where the House is supposed to be voting on this package today. $2+ trillion bill. We went through some of the details on the bonus Wednesday show, but today looks like we're finally going to get it done, and within days and weeks we're going to start seeing money heading out the door to individuals and businesses, and so that's a good sign. The Fed has been carrying the burden of fiscal response for this entire period, lowering rates and creating new facilities and trying to bring liquidity into markets. So they have been doing, all of the heaviest lifting, and now we'll finally get the fiscal burden being delivered.
And Tony, when you're talking about the economic data, so we got the jobs number, which was the unemployment claims, which is 3.5 million people, it's shocking. But that's actually a good data point. That is a check for $444 a week in 3.5 million people's hands. That's not a survey or anything. That's an
right.
unemployment claim.
Yeah, we call it one of the automatic stabilizers out there is the unemployment insurance.
Yes.
Programs, money for for the food programs.
Yep.
Are also another automatic stabilizer. You can go out and file for those benefits, and those are the two sort of traditional vehicles for getting money back into the economy. And so it's big. This is it's a lot of money. I think we were talking. You just heard Brendan. Brendan's in DC. John Fagan is also in DC. Our friends from Markets Policy Partners. I'm actually coming to you from New York today to do a quick run into New York to pick up tax papers and mail and some other things, and then I'll be heading back to the mountains of Western Pennsylvania. And hopefully, I have not come in contact with any people, and I have no intention to come in contact with any people or touching anything. So I'm not going to be spreading the virus, but needed to pick up something. So I'm in Manhattan for this show.
Is it a ghost town?
Driving around Manhattan is it's bizarre.
So people are taking it seriously.
Yeah, I mean, you could drive around Manhattan and not see traffic on really early Sunday mornings, or even 2 or 3 o'clock in the morning has more traffic than Manhattan has these days. So it's a surreal sight. But the weather's beautiful right now. I mean, it's a gorgeous spring day in New York City right now. In normal times, people would be thinking about getting outside, getting an early start on the weekend, and and hopefully we can get back to those days at some point. And
that's what this $2 trillion is intended to do, to get us there quicker.
That's right. One of the things that we keep seeing is people keep comparing it to the 2008, the 2009 stimulus plan.
Yep.
There was the 2008 plan, which we talked about, that was getting 140 to 160 billion dollars worth of checks out the door. That was in the Bush administration. Then you had the Obama administration stimulus plan that came early in 2009. And people keep saying that this fiscal package is the biggest since then. And they put the $2 trillion number up against the $831 billion number and say, see how much bigger it is. The truth is, it's even bigger than that. and because of the speed in which this money is going to go out relative to the programmatic spending that we saw in the first year of the Obama administration. That was roughly $830 billion. It was divided between checks and assistance and some housing housing spending. A big chunk of that money was going to things like financing infrastructure and energy programs, things for programs that had not even been created yet. And so if you look back at that, if you're trying to just do the math on the size of that program relative to GDP, it's not close. This $2 trillion, I think almost every dollar of it that where there's demand for it is going to go out this year.
Yeah,
right?
that's the goal. And the only reason that it won't go out this year is because of logistics, and we didn't get it out. It's supposed to go out immediately,
And I don't think the logistics are going to be that hard, to be honest with you. I mean, they're hard.
No, I agree. We'll get it done.
We're going to see mistakes in this. We're going to see like some sluggishness here and there, but it's not going to be. I still think like if there's demand, if there's pull for this money, if people are demanding the loans in particular, we know the checks are going to go out.
Yep.
The question is, the demand for loans by small businesses and big businesses. We know big business has the infrastructure to go do this. Small business, most people have not applied for some kind of government loan before, so they don't really know how to do it. My sister is a dentist. She's trying to figure out how to do it. I'm hearing from other people on how do you do it, And
so actually on Monday, I went on the Small Business Association website and I started the application just as a trial. And the website was super slow. And every time I put in a piece of information, it was about 30 seconds to load it. And then the rest of the week, it's been down. So they can handle, a normal amount, but you need kind of the Amazon kind of website power to handle all these loans that are going to be coming. And I think we're going to get it done, but we're going to have to partner with the Treasury, and everybody's going to have to partner with private sector to get these loans out as fast as possible.
Yeah, and that's really going to be the big, I think we're going to be talking a lot about this sort of about the aftermath and what the lessons be learned, the sort of villains of the crisis and the lessons learned from the crisis. And certainly one of the major aspects will be the degree to which, you have under this, we've gotten questions about, the balance in this bill between support for corporations and support for workers and households. Obviously, that was kind of the political battleground up on the Hill, but not that many compromises really had to be made, given the fact that they ballooned the size of this bill from 1 trillion to 2 trillion in the space of last weekend. And so basically, there wasn't that much intense horse trading when everybody was just growing the pie bigger. So the parameters of the debate really going forward will be just to what we're speaking about now, which is, the big pipelines, the pipelines of money getting capital from Washington, D.C. to larger corporations and banks. Those pipes are wide gauge and well used and well maintained and easy to flow through on. But it's some of the other the other plumbing, narrower pipes, rusty, leaky, that kind of thing that might delay. And in a crisis like this, when you have, time is of the essence for getting this money to people to get ahead of this impending solvency crisis, a solvency crisis that hits households as well as businesses. And time is of the essence. And this is really where the rubber meets the road. And we're going to be, everybody's going to be watching very closely. It's going to be consequential for the economy, for individuals, for companies, for markets. And hopefully that money gets to where it needs to go in a timely fashion.
Yeah, I'll tell you, we were talking a little bit about me driving around Manhattan and Brooklyn a little bit last night, and and when I say surreal, it's like it's not New York in that you see, every bar and restaurant, nearly every bar and restaurant is closed. That's a surreal sight.
Yeah.
If those restaurants go from closed to boarded up, that is that's a disastrous side. That's a thing that we don't want to see. And at some point, like I know some banks are doing things like forbearance on payments. Landlords are doing some forbearance, giving some time for some of these businesses to make their payments. But if the money doesn't get there quick, that time runs out after a while. Not everybody can't wait forever, because everybody has somebody to pay.
Yeah,
right?
which why in the end,
right? Everybody
it might be better to do what Germany's doing. So the German government is basically just guaranteeing any loan made by a bank. So rather than us sending the money to the bar or restaurant who then pays their rent, it might just be better to cut out the middleman and just guarantee every loan.
Yeah.
And we might end up at that place.
I don't know what I don't know what the
I have no idea. I'm just thinking.
I have no idea what that number would be for the United States of America. It
would be trillions and trillions and trillions of dollars. I mean, because if we have to be shut down for say 2 months, you're talking about $6 trillion or something like that.
Yeah, something like that. But it is. But just to like sort of close out the point on this. That the 2009 stimulus package was very big. I think I argued at that time it should have been bigger, and it should have been better constructed.
Yep.
In the sense that it should not have been doing so much prescriptive, programmatic kinds of spending in it. People kept saying shovel ready. And we had these arguments about like, actually, there is no such thing as shovel ready. Like the people who are saying shovel ready are shoveling bullshit, right? Because
no, you're 100% right. Yeah, you talk to anybody that knows anything about construction, and you could approve trillions of dollars, but there's only 100 billion in America that could actually start, within the next 6 months.
There's no by the time you buy the shovel, all the other financing has to be in place.
Yep.
And all of your environmental permits and all of the other things that you do. So like all of the work that you do to get the thing to shovel ready is really expensive. So you don't do those things unless you have the financing. So that's why like shovel ready is a myth. There is no shovel ready.
I lived in Southern Connecticut. I remember driving on the Merritt for 5-6 years. The signs were still up that this improvement of the Merritt is paid for by the 2009. I forget what we called it, but it was the infrastructure bill. And that was done. It's still probably going on.
Yeah. So the point was that spending was done actually over a period of, even in the fourth year, there was some spending.
Yeah.
Really, the bulk of it was in the first year. Big chunk of it was in the first year. I don't have the percentages in front of me. Big chunk of it was in the first year. Another big chunk of it was in 2010 in the second year. And there was even some a good bit left over in the third year. That means that when you think about like the $800 billion and you think about it relative to GDP at the time, $16 trillion or so, it sounds significant, but it really isn't, because you actually have to measure it against the GDP of
that's the way to look at it. The nominal
it's
numbers. Irrelevant. It's as a percent of GDP, and I get this is 10%.
But the point I'm making right now is that $2 trillion relative to the size of this economy, if it's all spent this year, is significant. It is pretty big. It may still not be enough, but it is very, very big. It is by its orders of magnitude bigger than that last fiscal package.
Yeah, because no one's ever done that. It's spend $2 trillion to help the economy, but also do it immediately. This is unprecedented.
Yeah. Hey, John, what does this mean for what are fiscal deficits? What are deficits going to look like? And I know nobody cares anymore, but what does it mean for financing all of this?
Yeah, that was one of the parts of the debate on Capitol Hill that really didn't make a big appearance was the deficit. The level of urgency and the human lives at stake and so on and so forth cleared a lot of these issues out that, remember back to 2008, 2009, it was really, whether we should be doing this at all. And everybody remembers that first TARP vote that failed, and questions really were asked in a much more concerted fashion on what is this doing to the deficit. Right now, this is, we were going into this, it's obviously bears reminding that we went into this with, we were already going to be racking up about $1 trillion in deficit this year, estimated roughly. And this is layered on top of that. This is going into obviously a demographic situation where the social transfers and benefits for the retiring baby boom will put additional, all the models that everybody sees shows the deficit growing organically over the next few years, no matter what we did, pretty much given those expanding benefits outlays. And so this is, it wasn't an issue with this first bill, but certainly congressional leaders have told their members that they may have to do, plug the gaps left by this bill, come back for, 1 or 2 more rounds of fiscal spending. And we would expect the deficit to make a much greater appearance, deficit concerns to make a much greater appearance in these later or next rounds of fiscal stimulus debate to the extent that we need them. And it looks like we certainly might. But it's not just the federal government. That this is a really powerful narrative that's sort of coursing through this crisis, is the fact that not just the federal government, but the corporations that have come into this, everybody's on a different footing, and some corporations have come in with a lot of leverage. And why did they take on that leverage? And that is obviously implicating questions about share buybacks and that sort of thing. And you can also say a lot of households have come into this. Household debt has put individuals and households in very different situations. Some through no fault of their own, just given their income levels. But this is the kind of debate, and when hopefully the curve has flattened here and we're on the other side of this, it's we expect this to be a very significant part of the debate. Saving for a rainy day isn't exactly our strong suit in a lot of different sectors of the U.S. economy and government, and I think that's certainly going to be the subject of some real soul searching. And I guess the last point I would make on the deficit and the debt situation is, when you look at the Treasury market, that is definitely not registering any sort of concern. We haven't seen. We've got 10-year yields at exceptionally low levels. I think this morning they were, they're below 0.8%. This is not consistent with a market that is panicking about the expanding size of the deficit. This is a market that is telling us, give us more. And
I think they had a good, did they do 7 years? They did the 7-year yesterday, I think, that went off really well, or I can't remember. I actually, they did an auction yesterday that, went well. And so in fact, was one of the better ones over the past couple months. So, so that market seems to be recovering a bit.
Yeah, and the Treasury is ready to come out with longer dated. This may be the time when they finally come out with with the 50-year, and I think that's we didn't really take those at face value when they announced in the past. The Treasury was investigating it again, looking into it again, but the stars have aligned in a different way, I think, this time.
Yeah, I don't think it's impossible. I still think, though, that they talked about about the 20, but like the 30 is sitting out there. Why does everybody hate the 30?
I think
why is
that's
the long
most
bond? It's
point.
it's like, what's wrong with 30 years? It's like, the poor long bond was,
There's not really a demand for the 50 or 100 where the 30 exists. So if you want to get to the 50, you should start with the 30 and see how that goes. Don't just jump it.
Yeah, I agree. I just think there's a lot more capacity for the 30.
I totally agree.
I would just rather see them fill out that portion of the yield curve a little bit more than to fill. I don't see a huge need to go longer, and I don't think the market is there either. And there's a problem with market timing, right? Is like, you think you can go sell these things today, and then you're stuck with them for a long time. If things change in 5 years, and they sometimes do. All right, hey, let's take a break, and we'll come back. You're listening to the HPS Macrocast. Tony Fratto with HPS, John Fagan, and Brendan Walsh with Markets Policy Partners. We'll be right back.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
And we're back on the Macrocast. So guys, we saw this week, actually something that, I don't know when was the last time it ever happened. Somebody said like 30 years before, but the Federal Reserve Chairman Jay Powell went on the Today Show to talk about what's going on right now in the economy. I thought that was a really good thing to do. And I actually was surprised because I know how much Ben Bernanke went out to he did 60 Minutes and did a lot of kinds of interviews. I was surprised that no one else had gone. No other Fed chair had gone out on something like the Today Show. It was good to see him out there, though. It was I think we need more people. We need Jay and other senior economic guys out there talking about what's going on here, because I think for one thing, some people keep thinking about this in terms of the last crisis, and I think we need sort of a new voice out there talking, really explaining to non-finance economics land just what's going on out there. And I'm not sure that people are what people are hearing on their evening news really cuts it and explains what he's trying to do. So I think it was good to see him out there. And then I do think that people are still caught a little bit in thinking about the banks, and how the banks are doing. You see, like, well, they're out there talking to me about what's going on with the economy again. Does that mean the banks are in trouble again? And that's not the situation here. And we could, if we see lots of defaults and those kinds of things happening, certainly that could be the case. But the banks today, I don't think they've ever been in a better position going into a crisis or recession than they are today. And I suspect that the regulators out there, they should be taking some credit for that. The banks ought to be taking some credit for that. They put themselves in a pretty sound place. I think I said this the other day, that the only sector of the economy that has been stress tested for the past 10 years are the banks. And so they are here actually to be able to contribute to the growth. And I don't think, again, like take this one day at a time or 1 week at a time, but we can feel pretty confident about where the banks are today, can't we?
Yeah, I think that's one of the real features of this. If you're looking for dogs that haven't barked, the U.S. banking system is certainly among them. It was they were the locus of the crisis, obviously, in 2008, 2009, which made the Fed the star of the countermeasures, the star of the stimulus that turned back the crisis. Obviously, TARP played a big role, but it was through most of the story of the crisis, it really was that financial sector seize up that was the big problem, met by forceful liquidity measures and other monetary approaches, and fiscal was certainly important, but it was in something of a supporting role. This is flipped. We've got the Fed has come riding to the rescue against this initial liquidity shock, and it's great to see Chair Powell out there and his messaging. What a curve he's had in terms of the learning curve on communications. We all remember back, a couple of years ago when his press conferences and appearances could be something of a high wire act. But he got very high marks for that on a really, high profile stage, that Today Show appearance. And, saying things like, well, we're not going to run out of ammunition, and sounding quite reassuring. And so I think that, the Fed has done such a, they've done their part to such a great extent here, and the banks, the banks coming into it and fighting form, Yeah, so far so good. Obviously, as you mentioned, Tony, the solvency issues that we're going to be confronting over the next weeks and months will obviously have some, have some blowback onto the bank's balance sheets. But boy, it's so far, if you're a proponent of Dodd-Frank or a regulator, you don't want to unfurl a mission accomplished banner. But for now, you've got, a lot of things to be proud of.
Yeah, and we've Dodd-Frank wasn't perfect, and over the years we've kind of figured out and adjusted it. But the big thing with Dodd-Frank was two things: one, hold more capital, and two, no prop trading. So the big banks aren't making huge bets, and I think that has proven to be what has created these fortress balance sheets within the banks. And knock on wood, we should be able to ride this out. And then also, Tony, you're a communications expert, so I think it's really important so like Dr. Fauci did a Instagram live interview with Steph Curry, and we have Chairman Powell going on the Today Show. This isn't a fiscal. We're shutting down the country, and people are scared. So yeah. If you need to get to the medium where everyone can listen to you to explain why the Fed is doing all these things and to help calm the fears. So it doesn't make sense to go on CNBC where only finance people go. You have to go where the people are going to listen to you.
You really do, and I can't emphasize this enough. I mean, we've always said, those of us who live in, dealing with the economy and markets, we think everybody's paying attention to what we're doing and saying. Even people who are involved in politics and government, they think people are paying attention to what they're saying and doing. And the truth of the matter is people just aren't. Now, there's been an uptick in viewership for CNBC and CNN, and a little more people are paying a little bit more attention to the news. But even today, it's nowhere near the attention paid to culture, to things in the entertainment space. And the numbers are off the charts in terms of eyeballs, an attention span that regular people have for these topics. So some people, I don't know if people thought it was weird that Tony Fauci went out talking to Steph Curry. I thought it was brilliant. I don't know if people, I guess it was unusual that Jay Powell went on the Today Show. I would be in favor of Jay Powell sitting down with the Kardashians if that means that their audience is going to get a chance to listen to him talk about these things. I suspect more people have seen a tweet criticizing Jay Powell than have ever heard Jay Powell utter a word.
I think you're 100% right.
That's
right?
Totally right.
Yeah.
Right? It's not even close.
Yeah. So Dr. Fauci went on, a Barstool Sports podcast, which is one of the heaviest listened to. Jay Powell should go on that podcast too.
Absolutely.
You have to get to where the people are.
Yeah.
And explain what's happening and why we're doing what we're doing.
Yeah.
Yeah. The esoteric, when you talk about the Fed, it's so, not that Jay Powell or anybody else at the Fed would be doing a victory lap right now, but, talking about the things that they've achieved over the past few weeks with these incredible, monumental liquidity injections and monetary policy programs, some unprecedented. They've stepped into whether you're looking at short-term funding market. Now, some of this might, again, this is still a work in progress, but the short-term funding markets, the repo markets, corporate credit has, back open for business in certain segments over the last couple of days. We've gotten a nice risk rebound, and part of that really has been underwritten by the fact that the Fed has unclogged some of these pipes. Overseas, offshore dollar liquidity, that's healed up a lot. The Fed swap lines are, coursing with liquidity into those markets. Euro and yen, even the yen, which was sort of stubbornly sticky for a while, that seems to have improved. The dollar's come way off of its highs. These are pretty esoteric things, and it's tough to explain to maybe the general public what the Fed has achieved. But they have in this sort of frontline role that they've had, it's really been an impressive degree of success so far. Knock on wood.
Yeah, I agree. There's I think they're doing all the things that they can possibly do. I know they could do some of it. They could do more. Some of this fiscal package is going to finance their ability to do more. I wonder if even though so we're here talking about how huge it is. I wonder what it's going to feel like in a month from now when we've done all of these things and we're still feeling like that we're in a recession and people are really frustrated. And obviously that we saw the president this week talking about go back to work. We need to go back to work. There was this talk about getting back by Easter, and I think frightened a lot of people dealing with the health outcomes, so that we're going to do a rush to get back to people mixing with each other when we haven't fully conquered the virus. So I know for whatever his motives are for that, we do know that a lot of people are going to be very, very frustrated very quickly. Not just the restaurant owners. I mean, right. Everybody is going to be frustrated by this. We're only a week or two into this,
right? And
people are frustrated. What's it going to be like a month from now when people are really, really down? Places are still going to be shut down. Baseball's not going to be back yet. NHL and NBA aren't going to be back yet. Broadway's not going to be back yet. You still can't go to your movie theater. Restaurants are still going to be shut down. People are living on government assistance in order to survive. And you say, wow, like we did all of these things and it's not working. And the truth is, it is working, right? It's like, you can't prove because the point isn't like, there isn't enough money. For all the money we're talking about, there isn't enough money to return, for the government to finance 3% growth and life as usual.
Right.
The only thing government can do is build this lifeline across, some really troubled waters, so that we can all, in an orderly, safe fashion, get to the other side. The point is to get to the other side, not to, to have the high life as you're going to the other side. And when you're used to the high life, as we have been, for a long time now, we've had a really terrific economy for a long time now. It's going to be very, very frustrating for people. So I get that people want to come back. There is a lot more explaining to be done, over the next few weeks, so that people don't get, to mitigate their frustration, to help them understand what's happening around them and why. We're very early in this. If it only goes for another 6 to 8 weeks, if that's all we're talking about, that is still a really, really long time for people.
No, totally. And the reality is, tackling this is easy. We shut down the country and we test and we hope to save as many lives as possible. The hard part comes when we reopen the economy, because we can't go from 0 to 100. You have to kind of do it in stages. And to do that properly, we need more data. We need what we need is more data to understand, okay, New York has had X amount of infections and they can go back to work and things like that. So, and you've made this point a lot, that the private sector, no one's not selling masks because they don't want to. If there's demand for it, we'll make the mask, and that you're seeing that now. And I also think we're seeing it behind the scenes on the data. There's a lot of companies that are trying to tackle this issue to help us reopen the economy.
Yeah, and I think one of the other points to make is the fact that there have been commentators and there have been calls for closing financial markets during this time of great turmoil. I think one of the points that we've made, obviously this is, our company's called Markets Policy Partners, so it's a little self-serving warning aside here. We think that it's very important to have markets open. At least, reduced trading hours is something that I think they're debating, and that's one thing. But the markets have given policymakers very, very important signals, and they are there to, financial markets are not always perfect. There are lots of inefficiencies, but they give signals as to how severe some of these ongoing stresses are going to be. You're going to be able to see that in credit markets, in financial markets. That's going to be a cue that helps and kind of holds Congress's feet to the fire if they have to do more. Exactly. It's going to be signaling to the Fed, if they need to do more. It's going to be, financial markets are going to be delivering that in a real-time basis during the trading week. And so far, we've seen I guess the concern would be, if policymakers mistake, a derating of asset prices here during this as more crisis signals. And I think drawing that distinction between orderly but downbeat market action and disorderly and systemically risky signals. And I think we've come a long way in the past few weeks with the fiscal stimulus bill plus the Fed's muscular actions to tamping down some of those systemic risks and the disorderly malfunctioning of markets. And if markets continue to go down, but in an orderly fashion, I think policymakers should see that as a perfectly constructive part of the process.
Yeah, I totally agree. And also, maybe you could shut the equity market. That doesn't necessarily matter, but it does matter in terms of making policy. But you can't shut the credit market. People still need to take out loans, and we need to get funded. So you can't totally shut it down.
Yeah,
but I was going to ask you.
I don't want to see. I don't want to see either market. I would see all the markets open and let people look. People. People need to buy and people need to sell. I can tell you, every one of these sales, everybody selling has found a buyer.
Yes.
We have seen moments where like bid asks have been challenging, but there are lots of reasons why people need to sell, and the expectation that they have is that they're going to be able to do that. And you can't go out and beat your chest in the good times about having the deepest, richest, most liquid markets in the world and then shut them down when things are moving around. And I don't like to see the volatility that we're seeing. There are lots of reasons for it, not the least of which is that we're upending the entire economy, right? Right. There's some pretty good reasons for why we have volatility right now, but I'd rather people be able to go out and get in and out of their markets.
Yeah, like right now, I'm not rooting for the equity market to go up. I would just love a week of up or down a couple basis points. I think that would be the best outcome.
Yeah. You mentioned that that we've got we saw the giant initial claims. Brandon and you and I have been talking about initial claims now for like a year.
Yes.
And we have
finally people are listening to us.
Finally we get the monstrous number. We're going to get that again next week. What other data we have besides claims next week?
So next week we get the March payroll number.
Yeah.
And then
we'll have real numbers to talk about.
Right. So I don't even know what the estimates are. Millions of unemployed. I guess it's just going to track what the claims are. But also for next week, we're going to get the initial claims that happened this week. So, and this week was really the week that everything kind of shut down. So next week, the unemployment claims could be 5 million also, or they're probably going to be 5 million.
I think it's going to be interesting. Like basically what we've done with initial claims is we've taken a couple months worth of what would happen in a garden variety recession. A couple months of layoffs and claims filing have been condensed into a week or two.
Mm-hmm.
And I worked for some guys who how do we say this? Weren't always the most articulate people. Said things and said things publicly that Paul O'Neill, as Treasury Secretary, said a couple of things. That George W. Bush, people I really love and admire. But would say things, said things inelegantly, and so Mnuchin got whacked. Yesterday for saying something about like these numbers aren't important. And I've become sort of like the Mnuchin apologist here because I think he really is doing a really good job. And I think he really does care. It was an inelegant thing to say, And here I'm going to defend him again, because like the point is that obviously it's awful for these people to have to go out and file for unemployment benefits. To your point earlier, though, they are getting a benefit. They're getting, they're going to get paid, and they're going to be able to meet their bills because of this, the unemployment insurance they get. I worry a lot more about the people who don't, but I think the who aren't, can't file right now, they're going to be helped by this bill, hopefully. But it's more scary for them. His point was that they're going into the system and they're getting money, and now we're going to have this wave of financing to come in that's going to take care of it. And from an economic standpoint, that's the thing to keep in mind. That was his point.
All the data is going to be horrific, but don't get caught up in the details. Get caught up in trying to find a solution to it, which, I mean, he was the driving factor behind this $2 trillion bill, and I'm not sure that he's getting the credit that he deserves.
Yeah. All right, guys. Well, we are going to have we will have that data to look forward to. Maybe by our we're going to do another bonus show next Wednesday morning. So we'll be next Wednesday looking forward, but at least we'll have some better estimates on payrolls. We'll know how this fiscal program is being rolled out. I think we'll have a little bit more clues on that. What the lending programs are going to look like, and so going to wish everybody a safe and healthy weekend. Stay away from people. Don't touch things. Don't touch your face. And John and Brendan and I will be back with you next Wednesday. You've been listening to the HPS Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.